The Great Depression was one of the most devastating economic crises in history. It began in 1929 and lasted for over a decade, leading to widespread unemployment, poverty, and financial collapse. But beyond the suffering, the Great Depression also reshaped the global economy in ways that still affect us today. It led to major reforms, new economic policies, and a shift in how governments respond to crises. Without the lessons learned from this period, the modern economy might look very different. In this video, we will explore how the Great Depression transformed industries, governments, and financial systems worldwide. Do not forget to like, subscribe, and hit the notification bell for more in-depth discussions on economic history. 1. The collapse of the stock market and financial system. The Great Depression began with the stock market crash of 1929, wiping out billions of dollars in wealth overnight. Banks failed, businesses shut down, and millions of people lost their savings. The financial collapse exposed the weaknesses of an unregulated banking system, leading to major reforms. In response, governments introduced stricter financial regulations to prevent another crash. The creation of deposit insurance and banking oversight helped restore trust in financial institutions. Today's banking safeguards, including the Federal Deposit Insurance Corporation, FDIC, in the United States, were direct results of the Great Depression. Without these changes, financial crises might be far more common. 2. The birth of government economic intervention. Before the Great Depression, governments played a limited role in managing the economy. But as the crisis deepened, it became clear that markets could not fix themselves. This led to the rise of government intervention in economic affairs. Programs like Franklin D. Roosevelt's New Deal introduced large-scale public works, Social Security, and labor protections. This shift laid the foundation for modern economic policies, where governments step in during recessions to stabilize markets. Today, economic stimulus packages and central bank policies are direct descendants of the interventions that emerged from the Great Depression. 3. The expansion of social safety nets. The suffering caused by the Great Depression highlighted the need for social protection programs. In response, governments introduced unemployment benefits, minimum wages, and public assistance programs. These safety nets were designed to prevent extreme poverty and ensure economic stability. Over time, these programs expanded, shaping the welfare states we see today. Social Security, food assistance, and healthcare subsidies all have roots in the policies introduced after the Great Depression. Without these protections, economic downturns could still push millions into extreme hardship. 4. The transformation of the labor market. The Great Depression changed the relationship between workers and employers. Widespread job losses led to the rise of labor unions, demanding fair wages and job security. Governments responded by passing laws to protect workers' rights, such as the 40-hour work week, overtime pay, and child labor restrictions. These changes helped create the modern labor market, where workers have more protections than in the past. Even today, debates over fair wages and labor rights trace back to the struggles of the Great Depression era. 5. The shift from laissez-faire to Keynesian economics. Before the Great Depression, many economists believed in laissez-faire policies, where governments did not interfere with the economy. But the crisis challenged this idea, leading to the rise of Keynesian economics. Economist John Maynard Keynes argued that governments should actively manage economic cycles through spending and investment. His ideas influenced policies that shaped modern economies, including stimulus programs and deficit spending during recessions. Without Keynesian economics, the world might still rely on outdated economic theories that failed to prevent the Great Depression. 6. The rise of consumer protection laws. During the Great Depression, many people lost their homes, savings, and livelihoods due to deceptive financial practices. This led to a wave of consumer protection laws designed to prevent fraud and exploitation. Governments introduced regulations on banking, loans, and corporate practices to protect ordinary citizens. The Securities and Exchange Commission, SEC, was created to oversee stock markets and prevent manipulative trading. Today, consumer rights laws, credit protections, and financial transparency regulations all stem from lessons learned during the Great Depression. 7. The globalization of economic policy. The Great Depression was not just a U.S. crisis, it affected the entire world. Countries saw how interconnected economies could collapse together, leading to a shift toward coordinated global policies. Institutions like the International Monetary Fund, IMF, and the World Bank were later established to prevent future global economic crises. Trade policies also changed, with governments recognizing the dangers of protectionism and trade wars. Today's global financial system is built on cooperation between nations, a lesson learned from the economic turmoil of the 1930s. 8. The housing market and mortgage reform. During the Great Depression, millions of people lost their homes due to foreclosure, exposing weaknesses in the mortgage system. In response, governments introduced housing policies to make homeownership more stable. The Federal Housing Administration, FHA, was created to provide affordable mortgages, leading to the modern housing finance system. Fixed-rate mortgages, government-backed loans, and housing subsidies all emerged from this period. Without these changes, homeownership might still be an unstable and risky investment. 9. The expansion of infrastructure and public works. One of the major responses to the Great Depression was investment in public infrastructure. Governments launched massive construction projects to create jobs and stimulate the economy. Bridges, highways, schools, and dams built during this period still stand today. This era proved that government-funded infrastructure projects could drive economic growth. The idea of using public spending to boost economies remains a core strategy in modern economic policy. Countries worldwide continue to invest in infrastructure as a way to create jobs and support economic development. 10. The lasting impact on economic thinking. The Great Depression changed how economists, policymakers, and ordinary people think about the economy. It demonstrated that unchecked capitalism could lead to disaster and that governments must play a role in maintaining stability. It also showed the importance of financial regulations, social safety nets, and long-term economic planning. Every major economic crisis since then, from the 2008 financial crash to the COVID-19 recession, has been shaped by the lessons of the Great Depression. Even today, economists study this period to understand how to prevent future downturns. 11. The evolution of central banking and monetary policy. Before the Great Depression, central banks had limited roles in managing economic downturns. The crisis forced governments to rethink monetary policies and expand the responsibilities of central banks. The Federal Reserve, for example, shifted from a passive institution to an active player in stabilizing the economy. It introduced measures like interest rate adjustments and money supply control to prevent financial collapses. This transformation laid the foundation for modern central banking, where institutions like the Federal Reserve and the European Central Bank play a crucial role. Today's monetary policies, including quantitative easing and inflation targeting, were shaped by the lessons of the Great Depression. 12. The shift in agricultural policies and rural support. The Great Depression devastated the agricultural sector, with farm prices collapsing and rural communities facing extreme poverty. Many farmers lost their land as banks foreclosed on loans, worsening the crisis. In response, governments introduced policies to stabilize agriculture, such as price controls, subsidies, and rural development programs. The U.S. created the Agricultural Adjustment Act to regulate crop production and prevent overproduction. These policies evolved into modern agricultural support systems that protect farmers from market fluctuations. Today, subsidies and food security programs worldwide are a direct result of the agricultural reforms that emerged from the Great Depression. 13. The strengthening of trade policies and economic cooperation. The Great Depression exposed the dangers of isolationist trade policies and economic nationalism. Many countries had imposed high tariffs, such as the U.S. Smoot-Hawley Tariff Act, which worsened the global downturn by reducing international trade. The Great Depression was a dark chapter in history, but it reshaped the modern economy in ways that continue to affect our lives. It led to stronger financial protections, social safety nets, and government policies that help prevent economic disasters. While no system is perfect, The lessons learned from this crisis have helped build a more stable global economy. What do you think? Do the policies from the Great Depression still work today, or do we need new solutions? Let us know your thoughts in the comments below. Do not forget to like, subscribe, and hit the notification bell for more insights into economic history and modern finance.